you don't need a factors, you don't need a system, because then you are getting yourself in. So what we have done, for example, we have made it very simple that look, only twice in a year we will do the rebalancing. At the time of creating a portfolio, the weightages are equated.
So with me, I have Amisha Vora, Mr. Balasubramanian and Mr. Anunaya Kumar. So, sir, I think Bala sir, आपका video. Can you hear me?
Yeah, I'll call you. Yeah. I can hear you. I can hear you.
Yeah. So, firstly, welcome to this AIF and PMS conclave too. Yesterday and today, between these 2 days, this is the last session. We've done more than 55 sessions in last 2 days, and it was full of learning and got to learn a lot. In fact, Mr. Samir Kumar had come from Aditya Birla, Samir Narayanan sir, and he represented the house views on equities, Bala sir. And Siddharth was there, Amisha, in the morning, and he talked about the importance of quant investing. And with me, I have Anunaya also, who joined us representing 361 Asset Management Company. So thank you, first of all, for taking the time out and joining the session.
Hi, Vikas. Thank you so much for having us. Hi, Bala. Hi, Ananya.
Yeah.
Right.
So thanks, because I still remember last year we had a similar show, and when you sent the invitation, I could recall the discussion we had last year on the same subject.
Right. I was telling Manish ji, your ROMG head, is that if Bala sir can go to smallest of the smallest town in India, travel and talk about the importance of SIP, and you see where the SIP numbers are, then sir, ये तो AIF PMS का कॉन्क्लेव है. मेरा तो रिक्वेस्ट है कि मेरा हक बनता है सर को कि आधा घंटा का उनसे मैं उनके बिजी शेड्यूल से टाइम दूँ सर. So thank you so much for accepting.
My pleasure, Vikas. Yeah.
I respect the kind of work you, Nilesh sir, all of you have done in the mutual fund industry, sir. Hats off to you people. Thank you so much.
Thank you.
All right. So what I do is, I have requested, while I'll be asking few questions to Anunaya, I have also requested him to join and come on the other side of the table like me and ask few relevant questions which he thinks is important from an audience point of view. We had about 10,000 investors attended this session live yesterday, and we had about up to 8,400 investors now who are watching us live. Now, the first question which comes from my end is that I'll straight away go to is that your views on quant investing, because this is something which is shaping up well both on the mutual fund side as well as in the alternate investment side. And then I'll go to Anunaya and Bala sir. Yeah.
So, Vikas, there are certain trends which are very evident globally. For example, just about, say, 25 years back, almost 85 to 90% of US money was managed actively. Then started the trend of passive management, which is following the indices. The ETF trend, low cost, following the indices. Then started the trend of quant. So as we stand today, now almost 30% is managed actively, 30 to 35% is managed passively, but 30 to 35% is managed by way of quant. Which means that while the money is managed with quantamental approach, the cost is not cheap. So people do not care just for cost by being in the passive market. It is reasonable cost, but better performance. And across the board, when you see performances of the global quant-based funds over 5-year, 3-year, 5-year, 10-year period, they are substantially better. And if you ask me, one of the key reasons is, as we deep dive and understand, one of the key reasons is that markets always reflect, as we say, greed and fear, the emotional biases. So when you work with your theory or your objectivity in a non emotional way, which is put all your logics, algos, data, strategize, but keep out the emotions, definitely performance improves. And I feel in India, only 1% of money is managed by way of quant. But this will take the route which US markets have taken, and quant, as we move forward, will be a very large pie within the money management. As we know, most of the mutual funds have started launching their one quant scheme in some way, but the trend will continuously pick up.
Okay, great. Anunaya, you recently had a launch of Quant Mutual Fund. Are you so your views on that first, and then your views on would you like to replicate the same under the AIF and PMS?
Thank you, Vikas, and good evening, everyone. I think that taking from where ma'am has left it, I would say, quant is something that you cannot avoid, or I would call it a smart beta as a space. You cannot avoid for long. Why? Because as we grow in size, alpha creation will start becoming that much more difficult, and you would need somewhere wherein you have the factors coming to play, keeping the emotions away, and start contributing. Well, I'm a great believer as a house, we also are active managers, but at times you would see that over analysis leads to paralysis. So, so at least what it does, these factors, what it does is that it helps you at least catch the trends ahead of time, and that becomes one of the reasons for all those alphas that we are talking about. Another aspect over here is, how simply you are able to communicate on your factors. Where the bigger problem on the acceptance among the partners emerges when you say, look, it's a proprietary model, I'm not going to talk about it. So transparency on what the model is, exactly what we have done when we created a fund of our own. We went ahead, spoken with the people on what this quant is, what are the factors that we are keeping it, as a part of the quant constituent. And the last part is keeping human intervention completely away, where again the mistakes happen when we leave 20% discretions for us to take up on. And that is where the recipe of challenging times or the disaster starts coming in. Because if it needs to be done, then you don't need a factors, you don't need a system, because then you are getting yourself in. So what we have done, for example, we have made it very simple that look, only twice in a year we will do the rebalancing. At the time of creating a portfolio, the weightages are equated. I even do not want to apply my emotions on active weights. So 3% is the limit that we have kept at a stock level at the time of building the portfolio. Thereafter, passive breaches are allowed, but actively I will again go back and look after 6 months and see how do I really need to do the balancing act or not. I think that's what has worked very well for us. Our quant fund has given a very great returns. It's available in the public domain. Now, for you to ask me, would we be keen on getting it on the AIF platform or a PMS platform? I think the early stages, as you would understand that these are the evolving strategies. The reality is, despite all of it, and factors and smart betas are contributing to the return, the size of the market for this space is still very small. So it is taking time among the people to accept it. But yes, sooner than later, as we evolve, we will evaluate on the merit of launching it on the platforms.
Sure. Okay, Balasa, coming to you. So you spent almost 3 decades in terms of equity investing and one of the largest investment managers in India, managing public money for over 22.5 decades yourself. So my question is, one, on the quant investing. Second, would you like to have these sort of strategies to be launched by Aditya?
Yeah. So I think it's evolving, right? As the market becomes bigger and bigger, deeper and deeper, I think the fund management also will keep evolving from active to the passive, passive to factor investing to the quant investing, which will come. Second is technological advancement. in the world of investment is also equally high. So when I mean technology and advancement today, for you to spotting the trend, see, normally in my early days, we used to look at technical analysis as a support to the fundamental analysis. So we do a fundamental analysis, we do an balance sheet analysis of companies, look at the valuations, and then we still go and look for confirmation coming from the technical chart. Technical chart may not necessarily always right, but at least used to give you some sense of what could be the potential direction of the stocks. Whether you like it or not, we see it only to satisfy yourself. Your entry points are right, your exit points are right. Say today, this advancement of technology that has happened, information availability has become so plenty. And technological ability, if somebody is able to bring as part of the organization structure, then definitely quant-based investing will gain momentum. Just to give you an example, the quant-based investing was started almost about 10-15 years back in Japan. When that market crashed in Japan, when there was a significant crash post Lehman Brothers crisis, the same factor-based investing had to go through the trouble time. So then people started looking for who created this model. Yeah, it was not fully foolproof, and only 60% it was satisfying the various conditions they would have put. And suddenly it became into the question mark whether the model-based investing can work. But fortunately, there was also given a learning for people to actually do a fine-tuning of the process. Therefore, we make it more and more robust from a stock selection point of view. See, quant-based investing, in my own belief, is nothing but it gives you a sharper analytical tool, which is taking away the emotional part, taking away fully on the valuation part also, because it doesn't give too much importance for the valuations alone. A fundamental investors will always give higher importance for the valuations and less importance to some of the other parameters. Whereas the quant-based investing will consider all the influencing factors. So all the influence factors, it could be valuation, it could be momentum, it could be supply of paper and demand supply of paper, it could be volume of trades and so on and so forth. It could also apply earnings, the momentum that comes in. So various things will apply, therefore it gets fine-tuned. But at the end of the day, my own belief is both will coexist. I think there is a market which also has to have a human touch. That's why we call it as a man and machine. We don't call it as only quant investing. We say man and machine will coexist. So unless you train the machine by the machine will not be able to learn. That's why that machine learning, what everybody is talking about, it is about training the machine to do what you want them to do. So as long as you become sharper, I think what is most important from a money manager point of view has to become sharper in giving the training to the machine and bring in all the moving components so that gets incorporated in the quant-based approach. At the end of the day, from market point of view, my own belief is both will coexist. The proportion of coexistence can vary because anyways the quant is a new. I would assume naturally this kind of investing will have a faster growth. That's why we as Artificial Mutual Fund, when we beefed up our team this time around, we also keep strengthening our team in our investment business. When we strengthen our team, we were looking at what kind of person we need to bring in now at this stage. Should I bring in somebody who has got 30 years of experience who has done only fundamental investing? Or you want to bring somebody who has got reasonably good experience with the fundamental investing and model understanding? Therefore, we felt somebody who understands technology, somebody who understands automation, somebody has got a passion to move away from balance sheet analysis to look at the numbers to the screen-based screening of ideas and then build it. That's why when we brought Harish Krishna as a co-CIO equity for me, the way we went about selecting the person is actually these are the parameters applied. Therefore, even as a Aditya Mutual Fund 30 years, either live on the past laurels, I also look at the forward and what we need to do a course correction. That's why we did our first quant fund launch that we did. And something as you asked the question to Anunaya, it can of course get replicated anywhere. I think once you have the proper understanding, I think you can create a model for multiple purposes, multiple strategies, different strategies, and we can bring in. But ultimately, from investors' point of view, this is one of the options that they get, one of the choices they get it. The way I see is 60-68% always remain on core, which is basically the actively managed funds. 35-40% will become actually the satellite kind of portfolio. So initially, quant will come entry into the quant portfolio as a satellite portfolio. As it actually proves its existence, that yes, they can also deliver multiple cycles. See, the quant fund has not seen cycles yet in India. So we've not seen last 5 years, not seen a big crash in the market. and we're not seeing one-sided down market. And we have always seen upside market volatility in the index has been the least, not been tested yet. But we have seen the highest F&O position being built, but VX is under control. I think moment we see these kind of variances, becomes more to look at it. And then when the model is put to a test, then we'll also realize how these funds will also perform. But there is a merit, there is a space, but as the market becoming more and more deeper, I think this will definitely be one of the new asset class which will pick up. But Aditya Mutual Fund believe in having a presence in every segment of the market. We will be the expert in diversity equity funds. We'll have expert in fixed income managing money. We'll have expert in managing alternate funds. We'll also create expertise in managing quant fund. Of course, we are not a young organization like Amisha Vora's firm. I know her son is a young bright boy, come from Wharton, educated, and he brings that new learning which you learn from the college, right? And then it brings in newness. Whereas we have to learn and bring the newness, that which I can always do by creating a talent pool. And that's the only thing that we can do as a firm. Of course, me as an individual can learn on an ongoing basis, be open to new ideas, which also is there. And then bring in talent. And people like Amisha Vora's sons, being in youngsters, he would put a lot of things together and bring these new ideas. That's the way I think market will evolve.
Sure. Great, sir. Great. So before I hand over the mic to Anunaya, my last question, and then he will be asking you questions about markets, valuations, whatever he feels like from an investor point of view, what is relevant for them to know. Amisha, I want to come to you and ask you, we are witnessing growth in AIF industry. It is exploding in terms of size. You already run your own PMS also, by the way. Now, there are innovative products which are coming up, especially in the category 1, 2, and 3. For example, performing credit fund, which is doing well. And I have a similar question for Anunaya also, and then Bala also, same question, and then I'll hand it over to Anunaya. So, what are your views on that? These that I'm talking about. If somebody wants to participate in real estate, they can do it through AIFs. It's a financialization of real estate or a performing credit fund. Or maybe somebody is bullish on a particular sector, can think about coming up with a private equity in healthcare or private equity in whatever. Now, you on the other side do the similar thing on the listed space, where you work closely with the promoters and tell them to. I mean, if they decide to offload some of their promoter holdings, and then you structure. So we want to ask you these two questions: one, your views on the overall growth of AIF and PMS industry, and second, how do you structure the deal? Over to you.
See, as we see, and we all say this is the golden decade of India, and we are marching from fifth largest to third largest or to a developed economy, the whole rise will also reflect in surplus net worth stroke wealth of people. So at the large end, if you see in India, and maybe Anunaya can support better, there will be now more than 500 family offices. But as we go down, ultra HNIs are also big, and HNIs are also big. So on one hand, we just keep talking number of, now there are 14 crore demat account or 13 crore demat account, but within that, those with very large surplus is also rising rapidly. Now, when you have that kind of wealth at your disposal, you cannot put all your money into equity markets, despite the fact that that has the potential to beat inflation, that has the potential to give you highest CAGR, but a diversification into asset class do sip in. And when economy like India is going to do so well, different segments of India will also do well. For example, real estate. So a real estate AIF in different categories, be it residential, office, or whatever, I think it is such a nascent stage. And over next decade or two, we will see humongous growth in this segment, as once again evident what has happened in different economies globally. Similarly, you asked me about performing credit. You do need a vehicle which gives you better fixed income opportunity at slightly higher risk. and an ability to participate in opportunities which are collateralized but also not bankable. This is this segment which gives the required capital to the economy or promoters for growth, as well as investors the right kind of mix of risk and return. And I feel that as the markets grow in India mature, there will be many more variations which SEBI will also allow in the fixed income, different categories, and both these segments of alternative investments will flourish. And this is just the beginning. They are just scratching the surface. This size of the market or the money management will grow substantially from here.
So
And
my
you had some second question?
yeah. So I'll come to that very quickly post this. But before that, before I go to Anunya, so knowing the fact that when you were running a quant strategy under the PMS platform and you've been rebalancing it in every 2 months' time, and Anunya said that they do it in 6 months' time, the churning ratio becomes higher. Why don't you think about launching the same strategy under your AIF platform so that it becomes even more tax efficient and easy for the investor?
So no, from our side, we have definitely first as a first entry point, because as you know, Aqua, our first con scheme, which we launched, has given in first year almost 42% alpha by being into only top 300 stocks. And these are equal weighted stocks, which means that out of BSE 500, we eliminated 100 most illiquid, 100 fundamentally weaker. So, of that 300 stock, when we selected a portfolio of 25 by our strategy, of course, we have generated an alpha of 42% in first year, a total return of 70%. So, we see a lot of traction with domestic but also global investors for entering India. And that's how we have done our first global aqua fund, which can accept dollar funds. Going forward, yes, we will be having our domestic AIF. But if you ask me, this can become really mass, which is little time consuming for me. But as a organization, we are planning to apply for our mutual fund license also.
Yeah, that
Because
I
then
got to know. Congratulations. Bala sir,
it
one more
is too early days.
compliment.
This is too early days. But yes, this is what we want to do.
Bala sir has seen many players coming in from last 30 years. And you're
Oh,
working
he's
closely with
the
all of them on the board of MFI.
yes.
So thank you so much. Now, very quickly going to Anunaya and then coming to Bala sir for a detailed answer. Yeah.
So,
Same.
because let me put it a little differently. I think I'll probably build up where Amisha has left it. Let's look at two kinds of journey. One is a journey of an investor, which is a function of his ability to onboard the risk and so on and so forth, and the journey of an entrepreneur. So let's look at two journeys very differently. A journey of an entrepreneur, let's start with that. Assuming Vikas walks in into an idea and he needs an angel funding to begin and put those ideas into action. As he grows, he would need capital for a mid-stage growth capital, and then thereafter he will get into a late-stage funding, and eventually would want his company to get listed. So that is the typical journey of an entrepreneur, from a conceptualization of an idea to make it get public, a journey that anybody and everybody would want to travel. Now, during the journey, there would be a need of capital at every stage. And earlier you enter into the journey, for an investor's perspective, the risk appetite becomes that much more. Whether you call it a liquidity risk or a risk of businesses not going as per design and as per aspiration or vision. Now, when we look at an investor whose ability to participate in the journey is again a function of his own ability to understand the risk, onboard the risk, which is where when we segment the investors from an ultra HNI to an HNI to a mass affluent and emerging affluent and a deep retail is when a journey comes up. But in the scenarios when you look at the market caps getting bigger, obviously the ability of an investor to onboard that risk also become larger. Why? Because he has that much more disposable capital at his interest, which is to go and look at investing. And that's the way when we look at the two, opportunities, seeing a common point is where all these aspects starts coming in, which is where you started off saying performing credits or an alternates on the private equity or an angel funding, or to look at a category 3 AIF or a PMS, or then eventually the lowest one, which is the mutual fund, where the ticket sizes are pretty low. So that is the journey, and rightly mentioned by Amisha. I think what we are noticing is that people on the ladder, what used to be the top end of the pyramid, have started now seeing more broad basing in terms of participation at an investor's level. And they are pretty much, they're understanding the risks which are associated when you talk about a growth capital getting provided to the promoters through a performing credit funds. Or are you looking at a private equity between a mid stage to a late stage, and hence you see a liquidity risk, but you are looking for a better alpha. Investors are now understanding those. Well, we are also noticing the participations are getting far and more broader. The number of folio which are coming in is now much bigger than what it used to be at one point of time. This is where the emerging India is getting into, and which is a reason also that if I see an alternate as a space, it is growing almost 26 to 30% per annualize. So that's the kind of CAGR that we are noticing. No second guesses to it that it's a great reflection of what kind of economy that we are talking about on a growth side, and more importantly, what kind of wealth creation which are in the offering, provided you understand the assets well enough and you are in discussion with your advisor and advisors are advising you what fits well for your risk appetites. So this is broadening and broad basing in a larger way.
Sure. Bala sir, over to you.
Yeah. Now, I agree with Anunaya on this. See, one thing which is definitely is it's happening is the wealth effect. India has been rising. I think if we take pride in the Indian equity market has become $4 trillion size, and this will become further up to $10 trillion size, which is nothing but a reflection of the wealth effect. So the number of people who have created wealth, number of family offices which is going up, and number of people actually would have benefited on the ecosystems getting better. I'm just giving an example to a lot of people that assuming a scenario, you are close to Ayodhya and you used to own a land, and today the land price would have gone up by 10-15 times, would have got acquired by the government, therefore you get money and therefore you become richer. See, now what's happening is most of the assets which are otherwise locked up are getting monetized. Therefore, the wealth effect is reflecting across the India, is only continue to grow. And mutual fund has been doing a great job of making mutual fund to become where we are today, and I'm sure mutual fund industry will continue to be the driver of getting the financial savings into the capital market. And there is one area where you mentioned about performing credit. I think India needs, along the side of equity capital, India needs a huge amount of debt capital. I think you can't ignore debt capital while building your business. And you can have a discipline on having a debt capital versus the equity capital. What should be the ratio? Is like 1.5 to 2 times leverage. Generally is considered as a good leverage as far as the corporate balance sheet concerns. The moment it goes beyond that, then you start looking at other coverage ratios, right? The same way, if you look at it today, we are in a stage where the Indian companies are the least leveraged. Therefore, there will be a scenario which will come, performing credit will start coming in, whether it is a real estate space or with a non-real estate space. And it's also get better. I think 2 years back versus now, if we compare, regulatory framework, even on the credit defaults, have now become far more robust in terms of recovery of assets and selling it today relatively easier because the law permits. And same thing happens in the case of whether it is the debt or real estate funding with RERA coming in, and these are becoming very, very robust. So my own belief is alternate investment space, as Arunaya mentioning and Amisha mentioned, this will be because one is the base effect is low. Therefore, anything whenever base is low, I don't think we should be surprised if the rate of growth range from 30 to 40%. It can, and because the base is low, as it gains more and more size, as the economic value in the system increases significantly, you will find more and more AIF related products will give a birth. You will see private equity space is picking up. India has got the least private equity space at this point of time compared to global market. Also, we must keep this in mind. I think today we are talking about interest rates is stable interest rates in India. It's very neither too high nor is too low. Whereas global interest rates are high. I think there will be a time where the interest rates also start coming down. And that is the time people start looking for, when the interest rates come down, generally the correlation for equity market need not necessarily has to be bullish. I think sometimes we may make the mistakes. Low interest rates means that the equity market bullishness. But we must also count that equity market also discounts a lot of things well in advance. So there will be a period where equity market will go through a flat period and fixed income will actually supersedes an asset class in terms of rate of flows. So that is why I think the AIF Credit Opportunities Fund will become, even as a fund house, we have been running a real estate fund for quite some time. Only the advantage that we have as a fund house like us, being the system for long, I also know what mistakes we did. So that experience is there. That experience, I say, it's a great learning which you get it. Of course, at the cost of our own experimentation is coming, no doubt. But the learning also can be applied as part of my new business model that we build. So that's why we build our real estate credit fund. We're also looking at performing credit fund. But the question always remains, should we go upper on the yield curve by pushing a GREEP? Say 20-25% means it comes along with a higher risk. If it is 15-16% means it comes a little lower risk. If it is 9-10% means it comes substantially lower risk. Which segment in which you operate, that is you have to choose. And second is what kind of expenditure you have to do. In fixed income, always what remains critical is what expenses in equity product. You can always have a profit sharing kind of model. Whereas in fixed income product, whether you can have a profit sharing kind of model or simple expenses that you charge. These are some of the critical decisions one has to take. But the fact will still remain that alternate to permanent equity asset class, alternate to fixed deposits, alternate to real estate physical investment or gold or real estate investment. I think AIF will become one of the major alternate asset class and which could become a fast growing asset class.
Sure. So Balasubramanian, subsequent to that, one more question. It's an industry question, if you allow me, not to you particularly. Is that, you've been, you have your own friends, other CEOs working like Nilesh Bhai. You were there with us yesterday. And there are others here. All of you have been in mutual fund industry for over 2.5 decades. Spent a lot of time reaching out to smallest of the smallest investors. Now, when you run the company Birla Mutual Fund, you are the CEO and you have 2 kids, mutual fund and AIF PMS. It's been observed, and you talked about getting new talent. It has been observed, and I could be wrong, and you can tell me upfront, is that a lot of attention goes towards mutual fund management because of your first sight love, or it's very close to your heart, and you have a bigger responsibility of many investors joining the fund. On the other side, we saw that off late, last 2-3 years, and I don't know if Anunaya also has the same observation. Some of the large asset management companies started deploying high quality portfolio managers, started shaping up and restructuring the entire AIF and PMS space. So what could have been the reasons, sir? Over to you.
See, I think, one is, as I mentioned earlier, the customer segmentation is also keeps changing. I think earlier, the entire reason why all of us were extremely aggressive on mutual fund space, it was underpenetrated, and there's still a long way to go. And reaching out to every market segmentations, given the fact that fund houses like us who have been in the industry for long, therefore we have deep commitment to serving the growing needs of the customers are always high. Therefore, the penetration was also one of our deep ingrained strategy. That's what we have done. Now, having built that expertise, we are creating a separate verticals. That's what most of the mutual funds are doing. Separate verticals they create. Chinese walls are must. You need to have 2 different teams, and you can only derive expertise on the research and the macro understanding. But when it comes to the question of managing money, it has to be done separately. That's what all of us are doing. One of the reasons why mutual funds still remain a smaller player compared to the like Anunaya's funds would have grown faster than us. Maybe Amisha Vora's fund would have grown faster than us. Maybe the size should be lower, doesn't matter. But the rate of growth would have been much better. The reason is they have to only worry about, or maybe they have to only think about that franchisee. Whereas people like us who have spent 30 years in building a mutual fund, The larger franchisee is mutual fund franchisee. That's why anything that I do on the alternate business, I need to ensure I'm being very, very fair to the customers, or the same mutual fund customers, and being fair. And second is, if I take any amount of extra risk, as long as going is good, is fine. The moment the going becomes bad, then who will get impacted? Usually, actually, that particular franchise will get impacted, or it will impact the whole franchisee. So this is the dilemma I always have. So when I build business, I always look at anything that you do on alternate business, just ensure it doesn't become as a derailment for my larger franchises, mutual fund franchise, because a lot of retail investors are coming, large pool of investors are there. So this is the way it comes. Therefore, you'll see this. Only thing is, the mutual fund will keep building up the capability. Say, I consider like Aditya mutual fund should be like a BlackRock offering product solution in every segment of the market. I should be able to do that. Are we capable? We are capable. But can we turn it around overnight, building talent and so on and so forth? It'll take some time, because large organization will take some time to build each of this stuff. And whereas somebody comes fresh, can actually choose which path to take, which will have a faster growth and so on. So that's the way I think the decision can be taken. My own belief is you'll see both of them will continue to create their presence, and the mutual fund industry also will create their presence. Not everybody will do it. At least the large players who have been having a large customer base and presence, reach. And also I mentioned earlier, wealth effect is today is not restricted to Mumbai and Delhi or major cities. Wealth effect is actually spread across the country, which will continue to grow. Therefore, we can use a franchisee that we have built and build the other alternate business, as long as we know what risk we are taking. I think that is where people like us will actually measure the path of our growth, taking into account risk as a part of consideration. And somebody who is building it now, of course, they'll also give equal importance for risk, but probably their ability to take a little higher risk could be a little higher than people like. That's the way I think my view will evolve.
Right, great. Thank you so much. So, I and Anunaya keep meeting many clients. So now I would like to request him to take over from here and ask if any question that you would like to ask.
Hey, thank you, Vikas. I think one of the questions which I keep hearing, and I more than the keep hearing, I keep looking at many houses trying to capitalize, is the manufacturing. So we feel that manufacturing is the next big thing that's likely to happen. My only question, Balasar, to you is that while manufacturing does look like a big thing building up, but globally we also are seeing very inward approach the economies are taking. So everybody wants to do absolutely for themselves. For example, they don't want that I should be importing or I should be taking. Why not? Let me safeguard our own interests. When we talk about building a manufacturing hub, obviously one of the aims that I do carry for myself is that I should have a great exports as well, because I would want to capitalize on the opportunities through FTAs, so on and so forth. But if the world is looking little differently, how promising this theme looks to you if I have to go if I look at ignoring the shorter term benefits, but the look at long term, what kind of impact it can bring in. So your two thoughts on that.
Sure. I think you raise the right point, Anunaya. Definitely is you have to start somewhere, and basis which you have to give importance to each of the sectors. I still remember in the early part of our career, manufacturing used to be the largest component of the GDP, and over a period of time it got reduced, and we have service component is far higher. So naturally, the focus that came in to reduce the import and make it more self-sufficient from India manufacturing point of view, which in my view it's a step in the right directions. I think one of the area which I'm a firm believer, I think India is one country, the manufacturing capability is far higher than anybody in the world other than China. I think if leave aside China has got a huge capability, absolutely no issues. I think India, if you take the next, I think India has got huge manufacturing engineering capability. I'm talking about engineering brain, and in India has got an abundance of supply. Therefore, ability to actually have a presence in every segment of the manufacturing is, I think, very, very high. So that's something is now, I call it as the unleashing of potential of Indian entrepreneur model through the manufacturing is relatively easier than services. That's something is beginning to happen, for which the government is also giving a lot of impetus. Second is, I think worldwide, I think manufacturing sectors, every countries, especially developed nations, I don't think they will actually completely move away from import to manufacture by themselves, because no advanced economies, I don't think they'll go back to create for themselves rather than actually depending on sourcing it from somewhere else. Therefore, India maybe will play a very large role in the next few years, even to meet the export demand from global markets. At the end of the day, as the world is becoming larger and India is becoming larger in terms of consideration, some of the Indian manufacturing companies are now set up. For example, already in the case of defense space, there is a school of thought that currently exists that some of the defense equipment, whether you need to depend on Russia and the US for import, or you want to depend on some other countries. I think that is where I think India, and my own belief is, will establish, and the ecosystem gets developed as a result of various sectors, will also be very, very large. And last but not the least is India is the only country where there's so many states are competing with each other. It creates their own high-powered engine from respective sectors. I'm saying if you take every state in the country, you will find 3 or 4 families who have been in the business for the last, say, many generations. So I can vouch for in South, same thing I can say for Maharashtra. I think we have many promoters who have been in the business for long, but they have remained quiet. Now they are able to suddenly unleash the potential, given the fact that this sector is getting a lot of impetus. Therefore, my own belief is manufacturing theme will remain. I think India would remain at the forefront when it comes to the question of meeting export demand, which will come the next few years. I think we are building for the future. Therefore, my own belief is it will remain a sustainable theme. I think what is critical in this whole process is like recessions. I think if there is a recession comes, consumer sentiment goes completely for a toss, global recession comes, then naturally manufacturing sector gets a hit. So I presume where we have seen the past period of ups and downs, even as we move forward, we ought still be prepared to see that kind of volatility. But otherwise, can it remain as a permanent theme? And one belief is it will remain. Even I just want to ask one more thing I mentioned. One of the very inspiring thing I saw, I'm not naming the company, one of the companies who have been in the industry. I used to lend in the 90s. I used to lend money to them as a lender, and I've seen them for 30 years. Never gone in their life beyond a certain turnover size. And I saw the company recently announcing 1,500 crores capex. 1,500 crores capex is announcing. Suddenly, I was wondering why such a 30-year-old company is coming for capex. The product that he has created as niche product suddenly is coming in demand, and that is why I think Indian companies are discovering their own potential, and especially it's coming from some of the groups which have been there for a multi-generation but never unleashed their potential. And third, which I think I see a very interesting, the emerging trend is happening. The next entrepreneurs are becoming super smart than their previous the generation. They are becoming super smart. So probably they are born with the AI rather than even mobile. So they are able to actually think a little beyond what the father and grandfather would have thought about from the business point of view. So therefore, that is actually creating huge amount of value for the future, which is again I see it in some of the old groups. The next generation is actually willing to continue the business, run the business from father, and make it actually really bigger without taking risk. I'm saying without even taking undue risk as well. So that's why I see this theme is remaining as one of the theme which will remain. Of course, more and more supply comes. I think in our industry, the bigger problem is demand supply situation which changes. Even I have more money to invest, naturally I will create a bubble. Only thing, bubble never tell me when the bubble is created. Will come only if there is a downturn begins in the economy, for which everyone should remain aware, rather prepared.
No, I think Amisha, if I build further from where Balasar is leaving, so this is looking very rosy. Great scenarios, manufacturing, so on and so forth. But I remember one of the reasons why people have been putting a lot of impetus on a manufacturing and we navigating from a service to service plus manufacturing, because this would lead for a job creation, which is what is needed in the country today. There's another fact that, when the Modi government during the COVID time, they came up with a very innovative approach of a PLI, and they actually opened up in 14 sectors. They said, okay, fine, these 14 sectors are in for a PLI. They kind of, made a budget of almost 3.3 trillion INR to be used into this side. And there was a view that, all of it would lead to some 6 million job creations. So that was the larger picture that the government had created. Something which looked very innovative to all of us. The reality is, out of 3 trillion which was available, only 1.1 got consumed. Out of 6 million jobs that we're talking about, less than a million jobs only got created. And now we are talking about, should we see more industries getting part of under the PLI? My question is that what went wrong? When everything was available, the job was the need, opportunity there, government is giving so many incentives, yet industry couldn't capitalize, couldn't get to a level of creating that much of job. And now we are talking about getting more, components to this PLI scheme getting added. So where did we miss the bus?
So while I will definitely touch upon PLI and why PLI is not blossomed to the extent which it should be, I will also touch upon the manufacturing as a bigger theme. As you know, manufacturing has certain key advantages that we need, which is cost competitiveness. So, because every buyer will make a decision of either to make or buy, and buy means that if till the time other nations are making things more cost competitive, we have to import, we cannot manufacture. So, how are we changing this situation is what is more important to understand. Over the last 10 years, okay, one of my belief is I'm very apolitical, but I truly believe that the best CEO that any organization, private, public, MNC ever had, our nation's CEO beats all of them. Mr. Modi, because of the vision culminating into minutest detail and planning that we all as citizens really benefit out of it. So this question as a nation we have been trying to address in last 10 years, how to bring our manufacturing costs down. Some of the key components are, of course, the power cost, the logistic cost, the infrastructure cost, the land and interest rate costs. If you see from ports, roadways, uh, in terms of our freight cost, railways, everything, every area is touched upon. We are investing as a nation and in turn trying to reduce our costs of manufacturing and logistic. And as we try and keep achieving that, that's how you see it's a virtuous cycle which has happened. You want to increase your dedicated freight corridor, you want to improve your railway transport as compared to road transport, you want to have much better ports facilities, least loading unloading time. As you keep doing that, that itself is a job creating opportunities and gives further fillip to the economy. But while that is happening, our costs cannot come down overnight. And that's how this PLI scheme came, where you tell manufacturers that take this advantage on the shelf, pre-booked, so that till the time you achieve a scale, you get these costs, you get this benefit of taxes. I would say that from the worries that whether the PLI scheme is well construed, to the fact that once you really put up a facility, whether PLI money is hitting your bank accounts or it is still like earlier times, one more scheme where the money just doesn't come. We have traveled all those distances. When you speak to corporates, every time their PLI money has started coming into their bank accounts in time, no follow ups, no delays. As this confidence sets in, I think that PLI and a combination of a broader vision to bring our overall manufacturing costs down and become a robust manufacturer together will continue to play a across different sectors of manufacturing. See, when you start having railway capex, it has its own huge multiplier impact, which is on signaling, wiring, cabling, those steel plates, so on and so forth, bogies, motors, tires, wheels. So multiplier impact will continue to come. Similarly, when you do this for your defense, in terms of further back-end manufacturing, it happens. In a big way, so many vendor development industries will come. Over and above that, as you know, we have now much bigger visions for our nation. We want to make chip also in-house. We want to make our drones also in-house apart. So it is not that being the third or fifth largest economy, we always want to do it for exports. We ourselves have a lot of domestic size demand, and we can focus on import curtailment for this. So if you ask me, there was a time when the consumption was leading, service sector growth was leading, and that's why all the stocks in that segment re-rated substantially. Right now we are seeing within manufacturing the re-rating has happened because market always pre-discounts, advance discounts the things to come. But as the earnings start unfolding and sustainably over a longer period, the PEs will start contracting. But we believe that yes, this manufacturing theme is here to stay, expand and enlarge.
Just to add to what Amisha mentioned,
Yeah.
one more point was that PLI, when it was introduced, definitely is new to the system. From anybody who gets into that segment, there is also a fear that, okay, if I avail minimum turnover, I have to achieve. I mean, the PLI is also was encouraging large scale investment. How many of them will be able to actually make their investment? How many of them will be able to actually wait for the execution to get completed and get money to come in? So people also like to see the experience. In fact, as Amisha mentioned, the experience of the people who actually participate in the first round is actually proof of success. So therefore, when they announce more PLI schemes, unutilized funds are there, the more and more people have more confidence. And then starts, it's like GST compliance each month is improving. As they start saying, just to give one example, I was in a Bharat series tour to Maharashtra, deeper parts of the Maharashtra. I met some of the industrialists. I did ask a question that what has been the joyful moment for all of you as a business person? And I even forgot completely that is a removal of octroi. I completely forgot. Octroi was there, octroi even removed. I completely forgot because nowadays you don't even think about octroi. And this gentleman running a business for so many number of years, the joyful moment he says, well, a single tax when it came in, GST single application when I have to do, even if I pay 20%, 22% is fine. I probably end up paying higher than what I used to pay in the past. Doesn't matter to me. At least a lot of streamlining has happened. And octroi is completely gone. Then I remembered he's reminding me something which all of us were cherishing about that moment, then forgot completely. So that's the way I think people are actually looking at the once you start experiencing it, you'll probably see more people participating.
Building on that, let me ask you a very interesting question, which is, for example, we have done our own analysis as a house. We believe price to book is a great way of evaluating the metrics of the markets. Being expensive, not being expensive. Last 25 years, market has been at 3.1 on a price to book. And if I add one standard deviation to it, that goes to 3.8. What we have noticed last 25 years, every time market gets closer to 3.8, it starts receding. Today, we are pretty much closer to that. Now, if I go back in my own days when I was a wealth manager in early 2000, we used to follow a matrix on a price to earning. Every time you're closer to 12 on a price to earning or 10 on a price to, you should be a buyer. Around 17, you should be a seller. Now, Balasubramanian, what I wanted to ask you is that 10 and 17 has now become 26 on a price to earning. So that's been completely redefined. The journey that we are in today, the journey of a bull market or a growth market or India redefining everything, do we also need to get realigned in all those quants and to say that data are the great indicators but aren't the Bible anymore to follow? Because now we are in an uncharted territory and we are going to redefine all those matrices?
See, somewhere valuation will catch up. There is no question, because beyond a point, fundamental investing cannot be challenged. The valuation will play a role. Anything that happens excess has to get corrected. There is no question. Only thing, the excess can continue for some time. So I'm not making a judgment whether price to book 2 right, 3 is right, P multiple is 25 right, 26 right. Anything which is an excess in nature. What do you mean by excess? PEG, I'm saying. I think it's one of the parameters nowadays people don't even talk about so much. Is a PEG, which is the PE adjusted for growth. So as long as the growth momentum continues and the promise of growth momentum continues, I think we need to also look at the promise for the growth momentum. What we are doing is not ultimately going to lead to a actual outcome. I think one of the good things that has happened in the last few years is the outcome has been higher than the expectations. Therefore, the market continues to do well. And execution also has been, in real sense, the executions, we are able to see it and believing it. Therefore, as the execution happens, earnings will have to come. That's the way a market will make an assumption. Therefore, we see that current momentum. I am not using the word euphoria, because euphoria will come only if excess gets created. So therefore, that momentum in my view will continue. And second is, on the base of what is being done, it looks like we will be on a sustained growth path of about, say, 8 to 8.2% on a GDP. If I take nominals, about, say, 11.5%, 12%. If I take corporate earnings, about 16-17%. If I take corporate earnings on an average, then price to book multiples and PE multiples can be ignored for some time. That's something in my own belief is could happen. And last, of course, which has never happened in our country is local participation never been as robust as what we've seen today. And the local participations, is there any reason why it should get slowed down? It doesn't look like. In the sense, local participation will continue to be very, very strong. And because alternates are not there. To the extent premium valuation also comes on the back of that. So definitely, I think valuations up to an extent will okay. I think where I get worried, no more than worried, where I get see that we need to be prepared. We may go through a flat market, it's like time value corrections. India has not seen time value correction in some of the stocks. We have seen best of the companies like Lilladher have gone through time value corrections. We have seen most of the FMCG companies have gone through time value corrections. Yeah. And even wherever the excess happens, on a base effect, you make a huge growth that you show on the basis of the base effect. Anybody who produces EV today, definitely the growth rate will be about 100% plus. But the only thing is whether you pay a valuation on the basis of this, that will happen. Like even Tesla, for example, such a high growth companies, new businesses, seen his period of significant thing. But PEG was not matching. I think if you look at Tesla's, I'm just giving an example of Tesla. PEG was not matching with the price momentum. Therefore, it had to get penalized. A similar situation will happen for Indian companies as well. The question is which time will come, and that's something we'll have to see. I think what we normally, generally, my own experience has been saying, even if the valuation question comes, will it make the whole market suffer? Will it make certain segment of the market suffer? So my own belief is make certain segment of the market suffer, but not the whole market suffer. Therefore, staying invested in the market is more important from investor's angle as well. Even as a money manager, you rather stay invested across different sectors. Therefore, you don't get caught on one segment, which is the excessive valuation that happens.
Sure. So I think the follow-up question to that, since you mentioned about the CEO, and I have a great respect, and we all take a lot of pride in our CEO. But one thing which is also very critical to the functioning of a CEO is his ability to execute, freedom to execute, being empowered to execute, so on and so forth. Amisha, my question to you is that do you see a change in functioning of our CEO in today's time with a fragmented mandate vis-a-vis his ability to execute when he had a complete mandate with him? So do you see any change in his approach?
See, when you evaluate with a closed eye, you feel that yes, his wings could be clipped. But when I see or think through, I realize that the person, when it is with right intention and right passion behind it can navigate importing of Russian crude oil and still being neutral and still being able to manage relationship with US. Do you think that with his sole intention of what we want to do to be a developed nation cannot navigate with his partners and cannot bind them in or by their consent to something which is good for a nation, which is infrastructure building? I don't think so. He will not be able to do it. I think he will be able to do it. And I also feel then, as mm, as economy observers, we were feeling that certain checks and balances were required when we used to see certain excesses somewhere, right? Maybe from some perspective, but slightly questionable. So I think those kind of checks will come. So, having thought through about it, I feel that they will be able to, and particularly he'll be able to take them together. Someone who never used to get a US visa and navigates different presidentship in US along with uh, different countries. And I used to, when people used to earlier make jokes about his traveling and cost that India is bearing, I used to say that we have just seen FII money, we have not seen FDI money. This will lead to the flow of FDI money and awareness. And I today, with the similar conviction, believe that if somebody can manage relationship as diverse, as complex during COVID, if somebody has the conviction to put largest military or people movement at the border and still stall the moves of our neighbors, I think for him to navigate this, we should not underjudge his capabilities when required and navigate accordingly. And during his full majority, also, we saw that some of the farm related things we could not really go through. So I
Yeah.
feel that infrastructure spending part will not be a problem. Coming back to your earlier question, which you had asked, Mr. Bala, I would like to add that the confluence of three balance sheets being so strong has never happened in India's history. The government balance sheet with robust tax revenue collections,
Mm.
the
Yeah.
bank balance sheets, and still the individual balance sheets are also not as fractured as in many nations.
Yeah.
And our domestic debt to GDP is also very, very constructive and accommodative at this juncture. So this puts us in a different pedestal. So
Yeah.
while I totally agree that the same benchmarks will follow, which is price to book, ROE, and PE, but when the longevity of growth comes,
Yeah.
that is what going to get built in. Because why balance sheets are important? These three balance sheets, when they are in fine fettle, it will keep our inflation at check. And when inflation is at check, your interest rates outlook will continue to remain very moderate. And that is where the PE expands. So you get a combination of, hopefully, there can be blip because of monsoon, I'm not denying, but on a medium term basis, under check inflation, moderate interest rate outlook, good growth equal to slightly premium to our 10-year averages or 15-year averages of valuations. And in the similar fate, I would say that market will show time correction rather than huge price correction.
I think that's a great one. I think over to you, Vikas. Pretty much, the questions which I had in my mind,
Sure.
we are done with it. So one thing is pretty clear, because which is I think beyond any dispute or debate. India growth story is very promising. The tailwinds looks pretty much than the headwinds. Uh, I think one of the key headwind that probably all of us are keeping a very close eye is the cross-border escalations, where none of us have a control. But when the reality is, when the globally people are struggling with the word, so to say, stagflation or recession, I think we still have a reality. The reality is that you have to wait if you want to buy a car. So that's in India. India is a very different economy. It's a very young population, not yet under the plastic debt as the globally people are. And I think the general consensus is we have a great CEO who is leading the show pretty well. And I think with all of this in the background, yes, a growth will always come at a premium, and hence, if the price to earnings are slightly higher, price to books are slightly higher, none of this we are paying for today. We are paying for tomorrow, and the tomorrow is brighter. I don't think too many people will think too much paying that kind of price. I think that's the conclusion that we can draw from our discussions.
Sure, great. It was absolutely fantastic discussion. I take this opportunity to thank all the panelists for sparing the time and joining this call. I truly appreciate that, and I want to thank all the investors who are watching this show this so patiently. Thank you.
Yeah,
Thank
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 you.
you. Thank you, guys. Yeah,
Thank
thanks
you.
everyone. Thank you.
Okay, thanks. Thank you, everyone. We again had a very fantastic day. Let me just summarize so that some of you will have key learnings from the session that we all had from morning time. So we started up the day with Mr. Vikas Sasdeva, where he talked about change is the only permanent thing, and he talked about the difference between three different investment vehicles, which is mutual fund, AIF and PMS. So we covered up almost most of the technical differences also. And then we have heard Mr. Siddharth Vora from Prabhudas, Lilladher, the youngest fund manager, building up the robust system in quantitative strategies, running a PMS called Aqua Strategy, and have been successfully generating alpha in the last 1 year. Then we had a fantastic panel discussion along with Mr. Ashish Somaya from Vito Capital, CEO of Vito Capital, Mr. Manoj, who is the co-founder and CIO at Carnelian Asset Management, and the same was moderated by Mr. Nimesh Mehta, who happens to be the head of sales at ASK Investment Manager, where briefly they talked about various aspects of the economy. They also talked about the valuations in the mid and small cap. They talked about what are the triggers to be looked at while investing in mid and small cap sector, because that's something which is very volatile and one has to be very careful about. They also talked about how to read various headlines and use the same for your own benefits instead of just paying attention to the negativity which at times comes to us through various headlines. Then we heard Mr. Samit Vartak talking about how to value growth and how to grow value of your investments. Very technical, but he's given very good perspective about what are the 2-3 things that you need to keep in mind when you are looking at defining the value or a growth stock. He also talked about the re-rating aspect and the duration, which plays an important role both in value and growth. Then we heard Mr. Himanshu Upadhyay from O3 Bugle Rock O3 Securities, it is formerly known as O3 Securities, where he talked about how to identify winners at an early stage, especially from small cap or micro cap investing. He also talked about the internal rating systems that they would give based on how the balance sheets are leveraged, how it is positioned, what kind of order book do they have, and based on that, they do the internal mapping and then invest. The gentleman has really done a good job in terms of delivering the deliverables in the last 8-9 months ever since the fund has started. And we continue to believe that they would continue to find a lot of value in the micro cap space and identify them at an early stage and invest through PMS. Then we had another session from Mr. Sandeep Bansal, where he talked about the significance of various themes in equity investing. What we have seen last particularly 12 months or 24 months is that there are different themes playing out. For example, PSU started playing out well. And you had railway stocks, which had a lowest P possible, which is 1.5 P. It moved to suddenly 10 to 12 Ps. We saw a great amount of margin in expansion in the P in the railway stocks. So we talked about that how various themes. And as an investor, my submission to all of you would be, to be remain flexible about what how you are investing your own money. And I would not suggest that you should be only focusing on one particular style. You have to have different styles in your portfolios, and definitely the theme based investing does ask for allocation in your overall portfolio. As a wealth manager, I would certainly give 10% of my money to these, 10 to 15% anywhere to these theme-based funds. Then we heard Mr. Anirudh Garg talking about the advanced framework that they've developed, which is more of human plus quant, human plus machine framework, which is developed by Mr. Rajneesh Garg and his son Anirudh Garg at a family level first, and then they started managing the money. We also talked about how to deliver, how to get sustainable alpha, over the last 4 5 years. So we talked about that. We also talked about where does the risk come from. We talked about the bull runs and bull run. I mean, why should you pick up these themes? And you should be picking up these themes only during the bull run and not in the bear run, because these theme-based investing doesn't work during that time. Then we talked about Mr. Sharad Mittal. Then Sharad Mittal represented Anunaya Real Estate. He's the founder and CEO of a company. Recently started this company a few months back. Applied for the license, got the license, started raising funds from March onwards. Where he talked about the importance of financialization of real estate in India. He talked about there was a time when traditionally we used to buy apartments, and now we do the same thing through AIFs, which is called financialization of real estate, which is like nothing but doing a backdoor entry of funding the developers and getting close to 20% kind of interest plus appreciation both put together. To my mind, getting 20% appreciation directly in real stock, real estate directly by buying an apartment, etc., looks to be a little ambitious. So I come from a school of thought where I strongly recommend that if you are an HNI or ultra HNI, you should be looking at this asset class and allocate your serious money towards that. Then we talked about how to approach venture capital and private equity funds, and I see a lot of people investing in these private equity or maybe some unlisted shares directly without having complete understanding of the balance sheet. For example, there were many people who invested in Farm Easy company, the company called Farm Easy, and eroded their wealth. So I would suggest to all of them is to be a little more conscious about what you're doing, and the best way to play this is to do it through fund managers, because they evaluate the companies at a different framework, at different parameters altogether, and they do it properly, as in with the proper framework. And again, as I said, AIFs are unconventional way of creating wealth. Why are we looking at stocks only after they get listed? Why not we start looking at those companies at an early stage? For example, there's a company called AU Finance. You know the market cap of the company. I remember when I used to work for Motilal Oswal, Mr. Ramdev Agrawal invested in that company when the market valuation was only 60 crores, and they've created a big franchise out of that. As we speak, the market cap is at least 1,000 times from there. So why not you also start riding through that journey? From the time that you do angel investing, then it becomes a bigger idea, then it becomes private equity and venture capitalist fund, then the pre-IPO, and then by continue to be remain invested even after the company getting listed. If it is a good company, it will create. I can tell you that I've seen personally in many portfolio that it can have the potential to deliver 1,000% returns bare minimum in your portfolio, provided you really buy the good franchise. Then we also talked about Mr. Siddharth from Prudent Equity Asset Management presented the importance of valuations in investing, where he talked about the comparison of various benchmarks of mid and small cap, their earnings vis-a-vis his style of investments, where he has, off the record, he has delivered very good returns. His strike rate is 96% and really able to deliver very good returns in his portfolio. He runs an AIF Cat 3 AIF. Then we heard Mr. Sunil Singhania giving us complete overview about the economy. He talked about there are 140 crores of people, but out of which 60 crore people don't have the affordability to invest money in equity markets. Imagine if when they start investing, how the participation ratio can go up to. We also talked about the way comparison between any other asset class, for example, equity and real estate continues to be the good asset class, but when you compare that with other asset class like gold, silver, or fixed deposits, then what are the options that which you have or left out where you can create good amount of wealth? And he also talked about the difference between what is value and what is growth, and for long term, what delivers the better returns. And he said that he is very cautious about valuations. He doesn't want to buy companies at any price. He does not believe in growth at a reasonable price. Now, price could be something else for you. It could be something else for us. It could be something else for them. So it's very difficult and very subjective matter. So therefore, he said that well, we are very price conscious, but at the same time, we still look at a growing company. We don't look at turnaround company all the time. We look at companies which are growing their revenues. He said that categorically that we look at least 5 years of 4 to 5 years of time, and they develop their profits. Obviously, which is in line with the nominal GDP growth that we have, which is close to 12-13%. Then we had a fantastic panel discussion where we had to participate, where we interacted with panelists, Mr. Balasubramanian from Aditya Birla Mutual Fund. He is the Managing Director and Chief Executive Officer at Aditya Birla AMC. Mrs. Amisha Vora, she is the Chairperson and Managing Director at Prabhudas, Lilladher. And Mr. Anunaya Kumar, he is the President, Sales and Distribution at 361 Asset Management Company. So we began the conversation by talking about how quant investing is shaping up in India. What is the future? Do they have space or not? And then Anunaya started monitoring the session and taken this up to the next level of asking the other panelists and sharing his own views about how manufacturing theme is shaping up. Where are we missing on it? They also touched upon the new NDA government which is coming up, and the CEO, Mr. Narendra Modi, how it is going to lead the situation and continue this comment so that we continue a similar sort of execution that what we witnessed in Modi 1 and Modi 2 era. So I think it was a great day again. Lots and lots of learnings. I remember when I used to work for Motilal Oswal, and I had a direct interaction with Mr. Motilal Oswal himself. And he said that because first you learn, generally what happens is that first you learn, then you earn, and then you return. When I laid down the foundation of this organization, I did just ulta of that, which is first I thought that I would share, as much as possible, bring all the best brains from different pockets, and make them speak to all of you, share their perspective so that you can take the informed decision, because they typically work in a professional environment where they are backed up by a lot of research analysts and fund managers. So that was one. So I thought first I will try and return. And as a result of that, I'm glad to share that we are emerging as one of the largest platforms, because wherever we are returning, it's coming back to us. So clients are reciprocating the value add, and me and my team is doing at AIF and PMS Experts India. So we are earning, and then we will try and learn, how to go about it, because learning is equally important. Continuous learning, as Charlie Munger said, that you have to be a learning machine and become 1% wiser very next day. So because I had a chance to attend Berkshire Hathaway's AGM, and I had a chance to listen to both the seasoned veteran investor, Mr. Warren Buffett and Charlie Munger at Omaha, the only thing that I learned is that power of compounding. So I see to it that how do we help our investors to create wealth by understanding their need and their risk appetite and designing the portfolio, and then keep reshuffling it depending upon how the market behaves. So with that, I would like to conclude the session here. I once again take this opportunity to thank all of you from bottom of my heart with a lot of respect for joining the session. This conversation cannot be finished without thanking our media partner, ET Markets, for giving us an opportunity to reach out to all of you, covering up the stories and reaching out to all of you. So this is not possible. So I really want to thank from bottom of my heart to Mr. Rajiv sir, Shalini ma'am, Manvi for giving us this kind of support. Mansi, everyone, lot of corrections were done. So apologies on behalf of my team. I also take this opportunity to thank our title partner, Axis Alternates. It clearly indicates their intention that they really want to contribute and educate all of you, and that's the reason they decided to become a title partner. Then we had platinum partner, which is Carnelian Asset Management, White Oak Capital, and Chanakya, which is also known as Stepted Services. Then we had an amazing gold partnership with many partners out here, starting with INDSH, Bugle Rock, which is formerly known as O3 Securities, ASK Investment Manager, Prabhudas Lilladher Asset Management Company, Sundaram Alternates, and Prudent Equity. And you've heard all of them today. We also had a meaningful relationship with Silver Partners, which is Ampersand and Aditya Birla Mutual Fund. So with that, I would like to conclude my session and personally take this opportunity to thank all of them